Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. Here we are, believe it or not, Tony, we're almost into mid-January. By the time this show actually airs, it will be past mid-January. I can't imagine. We look back and where did 2024 go? And here we are almost mid-January, and I know it won't be long, and we'll be saying, wow, where did 2025 go? But as we always do, Tony, you and I, catching up with each other. What's been going on over in Minneapolis, Minnesota, professionally, personally? What's been going on with you in your life? And then we'll jump right into, we'll kind of parlay that into our guest we have over there in the studio in Minneapolis. You also have Mr. Keith Gangl, who's a portfolio manager with Gradient Investments. So he's going to be an awesome guest on our show today. Very excited about that. So let's talk, Tony, professionally, personally. Bring us up to speed on what's been going on in your life, and then we'll kind of let Keith talk a little bit about what's been going on in his life, and we'll jump right into our show today.
Yeah, well, no problem. I mean, I woke up this morning and the temp said -2 for an actual temp this morning.
Yeah,
with a high in the single digits. So Minnesota is very cold right now, and we actually do have some snow on the ground finally. We hadn't had snow
so
this year
last week when we recorded the show, you said there was no snow on the ground.
There wasn't. Nope.
Okay, so you did get a little bit of snow. So we got a little bit of snow here as well. It's in the 20s today, but again, we always talk about what you get today, we'll get in about 2 or 3 days. And sure enough, later this week, it looks like we're going to get single digits to even negative as well. So yeah, thank you. Great. We appreciate that. Really appreciate you guys over there.
Enjoy. Well, I'll tell you what, at my house, and then we'll see what our guest has to say about what he's been up to. But we kept busy. I actually did some deep cleaning. We moved the fridge and some appliances out of their spots and cleaned underneath and behind them. And now that hadn't been done since, I'm going to go out on a limb and say, the Reagan administration was probably the last time. Apparently, after I moved it out, it's like you find things.
Yeah.
Huh. Yeah, that was from when my son was little, too. And he's 24. He's 24 now. So that's where his toy went.
There it is. Yeah.
We got her cleaned out, but we also took time to watch a lot of football.
That's that time of year, right?
College
'Tis the season.
Playoffs and the NFL playoffs. So every team, I should have done a pick 'em, where I picked the winners, because every team that I thought would win their games in the playoffs.
Really?
So far.
Okay.
I've been spot on so far.
Do you do any of the gambling or betting with the odds or the spreads, or are you just talking about picking the team? Just at least pick the team.
I was just picking winners.
Okay.
But I should have done it. I talked to somebody earlier that we all know, Corey, and he's got money on it. And I said, well, I've picked all those. Why didn't I get in on this?
You should have. They're handing out free money.
I know.
It's all free money, apparently, as long as you pick the winners.
Right. But you have to pay in. So I don't gamble myself much, but I don't like to do that because typically I lose, but I probably should have. And then as of this recording, we record the show on Mondays, but tonight it's the big Vikings versus Rams playoff game. And of course, I'm a Vikings fan. Now let's talk to our guest, because we need to introduce our guest. Jason, introduce our guest to the listeners out there.
Yeah, well, a lot of my viewers and listeners, his face you recognize it. I know you do. You recognize the name Keith Gangl. He's a senior portfolio manager at Gradient Investments, and this is not his first time on our show. Definitely not Keith's first rodeo. Keith, thanks for joining us again. Keith Gangl, portfolio manager at Gradient Investments. Keith's been on our show. I'll bet over the last 3 or 4 years, he's probably been on our show a half a dozen times or more. Yeah. So it's always awesome when I can have a guest directly from what I'll call in the trenches, right? In the trenches of the market, of the investment management and managing portfolios, and what are they looking at, doing all the research and all the sectors and buy, sells, and trades, and when do we get in and what do we get out of, and all that fun stuff that the team at Gradient Investments does. So to have Keith on our show is awesome. Whenever we can have one of you guys, Keith. So thanks again for the relationship. Thanks for being on the show today. I love it when you guys can come on, because it really shares a lot of the what's going on behind the scenes, what's going on Wall Street, and sometimes what do you guys why did we just go through what we went through? And this is kind of what we'll talk about in our show today, but 2023, 2024, crazy good years, both of them plus 20% more. So what was that all about? Why, how? And then we'll talk about right here we are today. Just after airing this show, we're going to have a new administration. So kind of a now what's this transition? What are we anticipating through this political transition? And then moving forward in more of a future looking outlook, maybe into a deeper 2025, 26 and further outlook. So, but before we get deep into the guts of the show today, Keith, let's talk a little bit about you. I know you're a Minnesota Vikings fan as well, so I'm sure you'll be watching the game tonight.
We'll be watching. I'm hoping for a little better outcome than when I was, watching the Detroit just pound the Vikings, a couple weeks ago.
I'm sorry, that was a pretty darn good outcome, I think.
Yeah, congratulations. Last time I was on the podcast was beginning of the NFL football season. I said Detroit, is the class of the NFC, and I predicted it right?
Yeah, boy, they sure are. And
you look great.
Yeah, and we've been decimated with injuries. And so, as we record today, obviously we had a bye week this weekend, and it's what a savior, what an awesome time to have that, to be able to get that. And now moving forward, home field advantage. But yeah, I think tonight, as we record again on Monday, tonight, I think is going to be, I really truly believe it's going to be a statement game for the Vikings. I really think that they, after what, the dismal performance and the unfortunate showing last week against the Lions, I really think that they're going to come out tonight and make a statement. I really hope they do. They deserve to continue. They deserve to go further into the playoffs. And what are you guys thinking sitting over there in Minneapolis?
Yeah, I think that's exactly what's going to happen. What I love now is that we're matched up with Washington winning yesterday. They're going to be coming to the Lions' den, so I think the Lions will take care of business there. And then if the Vikings can happen to win 2 games in a row, hey, Vikings Lions rematch for NFC to go to the Super Bowl.
We could be matched right back up. I mean,
how good would that be?
It would be amazing if that happens, Mr. Shore. You mentioned a few minutes ago you think you should start putting some money on the line. Well, if we come to that, and I don't want to jinx either team here, but let's for the record, I know Carson. Our listeners and viewers know my son Carson and Tony. They love to get in the banters back and forth with college football and professional football, and they had a little a $5 wager earlier in the season, and Carson came out on the upper end of that. So I guarantee you, Tony and Keith, if you want to get in the action, I'm sure Carson would be happy to take
my money too.
I'm sure you will as well. But so if it comes to that, you guys just be ready. You'll probably get a text from Carson saying, "Hey guys."
Yeah, I made a mistake this year. Never bet against Detroit, and I've said since the beginning of the season too, Keith, that they were going to be the team to beat.
Yep.
And I still think that, and I still think they are currently the best team in the NFL. Period. Right now. So we'll see how it washes out on any given Sunday, they say, but you never know. But yeah, the Vikings are going to win tonight and march on toward victory. I love it.
I like it.
Well, what's even more impressive with the Lions, like you mentioned, is the injuries they've had, and they can still continue to win. So that's
with the number of, especially on the defense, they had a great defense before injuries started hitting us this year, and then you lose Hutchinson and Anzalone, and we got Anzalone back. That was great, but it's amazing when you look at the number of starters, offensive defense, that were on IR, on the injured reserve list, and then you look at the guys that are injured but still playing, and it's amazing. And every team goes through injuries, right? I'm not just saying, well, the Lions are the only team that has injuries. That's not true. Every team does. But boy, you look at the numbers stacked against the Lions as far as guys out and injured that couldn't play or playing injured, and then they were still able to pull through and do as well as they've done. That's huge, and I think that's really a testament to depth. It's coaching. I think for it's a depth. It's a testament to coaching. He's really got that team just geared on next man up. Right, we got depth. We got next man up. Everybody should be in there and ready to go at all times, and they've done a great job at that. So again, this week with the bye week, hopefully helps us get a little healthier, get some of our injuries taken care of, and then come out next week and hopefully get a good start in the playoffs.
Nice.
Yeah, that'll be great. Well, I think this is awesome. And to have one of the main portfolio managers. Now, your exact title, I think, at Gradient Investments is King of Gradient Investments.
Hardly.
What's
Oh,
your,
you
what's your
got a
title
promotion,
over there?
did you? Got a promotion.
No, I'm just a regular old portfolio manager.
King
That's
Keith.
what
I like
am.
that. It's got a ring to it. King Keith. I
King
like
Keith,
that.
yeah.
I like that.
But
I'll see if Binger can give me that title and stamped on my desk.
We'll
yeah,
get you a
let's
little-
talk to the
little desk
president of
class.
GI
Yeah.
there, Mike Binger, who's also been on the show. But you handle, I mean, a very successful portfolio, the Core Select, and that's done very well. And we're going to get into that too. But you know what? Before that, let's take a little break, Jason. Let's let our listeners know how they can get a hold of you. And we're going to give away some copies of your book, Empower Your Retirement. It's a great book. And listeners, all you have to do is give Jason and his team there a call. Jason, can you give our listeners that number?
Yeah, the number is 989-835-7203. Again, that's 989-835-7203.
All right. And listeners, the next 10 callers who call in and request a copy will get a copy of Jason's book, Empower Your Retirement. All right. And this is your Financial Empower Hour. I am your co-host, Tony Shore. I'm here with our host, Jason Cryderman, and our very special in-house guest today, and that's Keith Gangl. And Keith, you are a portfolio manager for Gradient Investments. I know Jason has a lot of great questions for you today to see where we're at, right, Jason?
Yeah, I think it's always awesome, again, to have some of the people making the calls, right? In the trenches, we'll call them kind of on Wall Street, the ones behind the scenes that are actually managing the money. And so when you look at Gradient Investments and the number of years we've been with them and the growth over the years and the amount of money that they manage now is just, it's crazy to look at how successful they've been. And the markets have helped as well, obviously, especially in the last 2 years. And so whenever I can have one of the portfolio managers like Keith Gangl on my show, that's awesome, because I want my listeners and my viewers to hear from kind of the guys in the trenches, the ones calling the shots, so they can talk about what have been some of the tailwinds that helped them in their portfolios, as you mentioned, Tony, especially the Core Select portfolio that Keith Gangl is the lead manager on. What have they done inside that portfolio so to help it, to make it be so darn successful, right? How much of the market has helped on that? Yet how much of it was just when they decided to buy and sell what they did? And nobody has a crystal ball, as we know that, but Keith, you and your team have done a phenomenal job. So let's kind of start off with talking about what the heck happened in the stock markets in 2023, 2024, and where we're sitting today. And then we'll end the show with where do we see maybe the next 2, 3, 4 years moving, going down the road.
That sounds great. We'll set the table of kind of what's happened in the last 2 years. I think it's very important just to understand kind of baseline. So when we get to the forecast part, we kind of realize what the markets have done and kind of the probably what we see going forward. But
sure,
you go back to 2023. Fantastic year. Again, if you go back 3 years ago, 2022 was pretty poor,
poor year in stocks and bonds across the board, right?
Yeah, that was, stocks were down 20%, bonds were down 13, absolutely terrible. Usually when stocks are down, bonds do a little bit better. That was bad due to high inflation, Fed raising rates.
Yep.
You fast forward to 2023, markets rebound. We have the stock market up 26%. The actual bond market doing more normalized, up that 5.7. So great year. And then the questions are, okay, what's going to happen in 2024? We were still positive. And why were we positive? And again, we're still positive now. I'm going to give you a little sneak preview of what's going forward.
No, that's good.
We're still positive as well. But unemployment rate, when people are working, they have money in their pocket, they love to spend. The U.S. consumer will spend. Unemployment is relatively low. It's at 4.1%. We just saw a data point last week. The number is 4.1. Just to put that in historical perspective, the average over long periods of time is like 5.5. So we're way low.
We're below average,
We're way below. And the 50-year low is at 3.5%. So at 4.1%, people are fully employed. Again, when they're working, they have money in their pockets, they will spend. So that was a key driver. So now what the market do last year? It finished up 25%. That's a massive year after, right?
Crazy.
26,
yeah, right.
25%.
Really good.
2 years over 25% back to back. And I try to tell and I'm sure, I get a lot of this information from you guys, Tony, but I'm sure you have the same thoughts and feelings. I tell a lot of my clients is that's great, right? We can celebrate those years, but 2 years of 20+% growth, that is not healthy. That is not normal. That cannot sustain.
Yep.
Our show last week, we called Bring Your Umbrella with you. I think the theme was to bring your umbrella. Not that it's going to storm, just be prepared because, yes, as we love 20+%, 2 years in a row. But, what happened? Why did the markets do that? And how did you guys place your portfolios during those such positive years?
Yeah, and the biggest thing, obviously, I talked about people working, but underlying that is corporate earnings were strong. They were actually 10% last year. Long term, if you had to pick one variable, the overall market for me to look at for the companies I invest in, I look at their earnings. What's their projected earnings going forward? And so last year in 2024, expectations were going into the year, there'd be that 10 to 11%. Now, as we're finishing out the year, we're going to get quarterly earnings report for Q4 starting this Friday. So very soon, in a couple of days, we'll see how the Q4 finish. But if they finish kind of where people expect, it's going to be about 9.5% for the year. So expectations were 10 to 11. It's going to finish that 9 to 10. That's a fantastic. Just so you know, longer term, it's about that 6 to 8. So if we can finish that, and that's why the stock market did so well.
Sure.
Now, expectations going forward, I'll give a little preview is expectations for 2025 are for 15% earnings growth.
Wow.
That is amazing. That's basically 2x what a normalized year. So there's definitely some tailwinds for some positive market things. We'll get into it a little bit, but
sure,
that's great. Inflation, which back in 2022 was a problem. We talked about bonds being so bad. Inflation reached 9.1%, and everybody felt it, right? You
Absolutely.
in Detroit is the auto industry. We had semi shortages. It was just everywhere. The price of food, the price of gas was horrible. It was up 9.1%. Now slowly we've worked that down. We're at about that 2.6%. The Fed's target, so everybody knows, is 2%. We're not there, and we've been saying for the last year it's going to take quite a while to get to that. Once that 9 down to 3 happened relatively quickly. This 3 down to 2, I think that's going to take a period of time. That could take over a year, and I think we're on that 2.6%. So it's not great, and everybody asks me, one of the questions I always get when I'm talking to advisors and clients is, well, my food prices are still relatively high. Unfortunately, that number is not deflation, right? It's not coming down.
Correct.
It's just going up a little less than where it was the year before, which again, if you put if you're working, generally speaking, your wage inflation's over 3%. So if you get the price of gas coming down, you get the price of food coming down, some of your major inputs on your housing and stuff like that, your wage inflation's at least offsetting those other problems. And again, those are all those things culminate to why we had such a good last year. And I think those are still in the mix for what, we predict for in 2025 as well. So.
Good. Now I know there's an article. I think you actually published it. Were a great contributor to it, and I think it actually was more fitting for 2023, called the Magnificent Seven. But I think that really echoed itself again all the way through 2024 when we talked about. I want to say it was over 80% of the market's growth was driven by really 7 or 8 companies, and then we look at 2028. Was that kind of the same? Was that almost a mirror image? I mean, what drove the markets in 24 that were the same or different than 23?
Yeah, that was one of the things for me managing with some of the portfolios I have is, I had a big overweight to those Magnificent 7 names in 2023. I dialed that back, but I still was involved with them because I think there still was a nice opportunity in 2024. And that's exactly what happened. They actually outperformed the overall market. Again, the market was up 25%. Them in aggregate are about 40%. If you look at all 7 of them, we had, obviously the leader was NVIDIA. Again, that was almost up another 200% after the 200% prior. It was just crazy. Now I do think that's going to start slowing as well. And now how do we position ourselves going forward? I think you have to have a balance. Everybody talked that, 2024 would be the market broadening out, which means other names would start working. And they did for periods. But if you look at December, how it finished, those Mag 7s actually took the leadership and the rest of the market kind of shrunk a little bit. And again, we still finished 25%. That being said, now how do we want to position going forward? Right? We still want to be involved in those as well. You could probably trim some of those winners, like I said, in video. You still may want to own it. That's what I'm doing in my core select portfolio. But as a whole, we'll have a little less exposure there. And I think the market does broaden out. But again, you still want to own those, pick your favorites. There's names that Magnificent 7 that we don't own, and there's names that we trim quite a bit as well. So that's how we kind of use active management here at Gradient.
Yeah, interesting. Interesting. Well, and obviously, we come out of 2024 and we had an election, and I've talked, we couldn't
What?
have I know it's probably new news. I know listeners, viewers, you're probably
Breaking news.
Breaking news. We just came out. Well, and I know all during 2024, every show we talked about it, Tony, every visit with all my clients, we talked about was this election.
Yeah.
And ever since then, ever since the first week in November, I know I have been so happy that the election is over, right? The election is over. And I haven't met anybody that doesn't echo exactly that same. Now that we move into where we are sitting here today and recording this show later this week and moving into next week, and of course, end of January, we actually have the transition of the current administration leaving, the new administration coming in. And again, we say new administration, it's almost a old new administration because we have President Donald Trump, who was a president. Then he took 4 years off where he was not, but now he will be the president again. So how do you see this? Are there any warning signs? Are there any things to look out for? Are there any really some maybe drastic headwinds we could be coming into here as the transition of political parties happen or moving into 25? Or are there any awesome tailwinds that we say, no, this is, and the reality is there's probably a little bit of both. And so what should investors look out for? What are you guys looking out for at Gradient Investments?
Yeah, you nailed it. There's probably be a little bit of both. So I wouldn't get too excited or too depressed. Again, that's the same thing we talked about pre-elections. Like if your party doesn't win or, it's not all in, all out. Yeah. So again, I think things set up relatively well. I mean, there's some of the things that we haven't seen the official policies, right? He's not in office. There's, just like all politicians, they promise a lot and they deliver a lot less. So
that's true.
I wouldn't expect anything less. But some of the main things, the one thing that I really appreciate is the taxes. I think that was going to sunset in 2025. I think the market was underestimating the risk of, if Trump didn't win, taxes, I think, were going up across the board for everybody.
Correct.
Not only were they for your...
I think it was a very safe assumption. We were all... It was one of the things we knew was probably going to happen, and it would have been one heck of a headwind because, as you mentioned, the consumer spends money. When they have reduced taxes, they have more money. They can spend more, right? But when people think our taxes are going to go up, and if our taxes do go up, we ultimately will probably have less money, which means less spending. And I don't see how that can be a positive thing.
That's a vicious. Yep, that's a vicious cycle, and that's exactly why. And I think the market was underappreciated. I think if Trump didn't get elected, I think those were going up, and I think that would have been a little bit more of a headwind that the market would have been starting to talk about at this point in time. That's not going to be the case. Now, again, I'm assuming that they'll figure out some kind of deal to kind of keep whatever's in place. Now, I mean, the bull case is for the overall stock guys would love to see, you as well. And Tony, I'm sure, doesn't want to pay any taxes either. You'd like to see that tax rates go down. I don't think that's going to be the case. I think me as an investor, would be plenty happy if they stay where they're at, for corporations and for individuals. And then you can, do some more long-term planning if you're a corporation. So I think that's a huge positive, or at least a potential negative taken off the table. Another positive, we'll do the pros and cons, is be the pro-growth policies. I mean, all these different business leaders have come out now after the election saying, okay, we can work with this. There's a lot of positive going on, and, America first, we'll get these policies, different things like that. Sure. Now, on the flip side, we can't ignore the fact that he's talking about tariffs, right? And,
big word right there.
Big word. I mean, it has a lot of implications, and they sound good, but they can be terrible as well. Usually when a company puts a country puts a tariff on goods coming in the country, what does that company do? They pass it on to consumers. So, right,
sure. That's raise the prices.
Raise the prices, and that increases. That's like a tax on that as well. So if you put these broad-based tariffs in place, I think that's a negative for the overall economy. I don't think that's going to happen. I think they're going to be more targeted, and I think that's kind of what he did in his first administration. He talked about at one point in time putting in Canada and in Mexico of putting these tariffs on him. They never happened because he negotiated a deal. So if you can use it as a negotiating tool, and actually Jamie Dimon just came out this weekend, the CEO of the largest bank, JP Morgan, he basically said, he actually likes tariffs if you use them as a tool. Now, if they're broad-based as a hammer across the board, that could be negatively impact the overall economy.
Sure. Well, guys, we do need to take a quick break, and we should talk a little bit more about how these things might affect the markets and what we are looking forward to or not looking forward to in the next year, higher taxes being one of them. Hopefully, things will stay the same or lower, but you're right. Tariffs might throw a wrench into that. We will see. Jason, can we give away a few more copies of your book?
I think it's a great idea, Tony. Yep, go ahead.
All right. Well, Jason, you have a great book, Empower Your Retirement, and it really lays out the groundwork for creating a solid income plan in retirement, what we need to be doing to save for retirement, and then what we need to incorporate into that plan. Listeners, the book can be yours. There's no charge, no obligation. Jason's even going to cover the shipping. So we're going to give away 10 more copies of that book. Again, it's called Empower Your Retirement. Jason, give our listeners the number that they can call.
Yeah, you can give us a holler here at the office at 989-835-7203. Again, that number is 989-835-7203.
All right. Thank you for that, Jason. And you're listening to Your Financial Empower Hour with our host, Jason Cryderman. I'm your co-host, Tony Shore, and we're here with Gradient Investments Portfolio Manager, Keith Gangl. Keith, you've talked to us about a lot of great things so far today, kind of where we've been, 22, 23, 24, how that's played out, and what it might mean for the future. And then you guys got into probably a warning, politics, a little politics, but we all were relieved, no matter what side you were on. Thank God the election season is over.
Absolutely. Amen.
For at least a few years. But now that we have the Trump administration coming into office here within the next week, what's going to be happening? Jason, any other questions about that? Or Keith, any comments?
Well, I think it's important, that we kind of just summarize a little bit about that last segment was, there's obviously positives from the consumer is when we have more money to spend. If unemployment is down, that means more people are working. That means more people have money. If taxes stay lower, which the Tax Cuts and Jobs Act of 2017 that was passed by the Trump administration, just when we look at federal income taxes, they lowered 5 of our 7 federal income tax brackets. So they reduced or cut taxes, which means we could potentially make as much, if not more money, but yet pay a lower federal income tax bill. That's a good thing for the consumer. That means more money. Then when you look at what could possibly happen in 2026, the tax law was set to repeal or sunset. And now with Trump being in office, what you kind of said, Keith, was we really think what we've heard so far, we haven't seen 100% yet because obviously his policies aren't on paper, but we've heard that there's going to be some form of extension of those tax cuts, which again, a very positive thing for the consumer. Less taxes, more money in their pocket to spend. So that's a positive side from when we look at the Wall Street or stock market, there's really 2 sides, right? There's the consumer and then there's the companies. The positive things I think for the companies are, like you say, this growth. And if President Trump is willing to allow a little more growth, a little more expansion, a little more bring back to America, maybe some more tax incentives for corporations. Well, now corporations have more money to spend. They're healthier. They can do more growth. They can do more R&D, more acquisitions. So if that's positive and we still see these growth rates, as you mentioned, in these corporations, what they're anticipating this year was around 10 or 11. We think it's going to come in pretty darn close to that. But then you said, Keith, that next year's growth on some of these companies, we're projecting the S&P to be maybe north of 10%, even up for 15%. And so if companies have this growth potential, that's a positive for the market and the economy. And if consumers have more money and less taxes, I really think we're possibly coming into some very, very powerful and beneficial tailwinds moving into 2025. What are you guys thinking there at Gradient, and how are you positioning the portfolios?
Yeah, you summed it up very well. You hit the key points there. And the other thing, before we jump into those, I'll actually give you some other stats. I'm a numbers guy, right? So it's like,
absolutely, yeah.
We saw those, 26%. We saw 25%. We look at history, how often this happened. It's happened 8 times since 1950 that we had 2 years that are above 20%. So a few times. And 6 of those 8 years, the following year was also positive. So 75% of the time. Again, we always like to use history as a guide. I mean, not that it's going to always follow it, but so which kind of surprised me. I thought it would be a little bit lower than that, right? After having these 2, great years, that you would get more of a kind of a subpar year. And then if you look at the average return of those 8 periods that followed those 20%, it was actually 12%. So
wow, that's still very good.
Which is again better than the overall average market. So now we kind of how we look at our forecasting again. Our crystal balls, hopefully we think is a little bit better than the guy next door to us or anything like that. But the things that you mentioned right away, it's earnings growth. the market's expecting earnings growth when you aggregate all those 500 companies at 15%, that is very aggressive. And if it does that, I think the markets are certainly, I think they could go up as well. I think that number's a little too high. I think that's more 10 to 12. But even at 10 to 12, like
10 to 12 earnings growth, that's phenomenal.
That's great.
That's wonderful.
Unemployment at 4.1%. I can't hammer enough, and you did a great job as well, as when people are working, they have money in their pockets, they love to spend. The U.S. consumer, that's they love to spend. And if they're working, they have money in their pockets and their tax rates aren't going up. I think they have a lot of discretionary income, which they'll spend, and that's good for corporations, which is good for the earnings. It's like a big circle. And so I think right now, those are all the positives. Now, the one glaring thing that we've been talking about a little bit for a while has been the valuation. What do you pay for stocks after these 2 big years, right? So if you look at all 500 of those companies, you aggregate kind of the earnings what PE multiples, a price per earnings, what kind of what we pay for them normally. We're around 21 times forward earnings. Historically, we should be, 10-year average around 19 times. Your 15-year average around, I think it's around 18 times.
Okay.
So we're a couple turns above average. But again, if the market's going to do 20 or 15% earnings growth rate, investors like myself are willing to give it a little higher multiple. Now, I think that multiple kind of compresses as the year goes on. And I would think you touched on it. You're, talking about your show, you bring an umbrella. That's kind of our forecast for the year. I think we get back to more of that normalized year. We don't ever really have a normalized year, right? It's usually, really good, maybe subpar.
Right.
We don't.
Well, what the heck is normal? I don't even know what that word means.
Yeah,
in the market.
We actually did a study going back to, I think it was 1940s. We were looking at the number of years that are normalized, which is that 8 to 10% year. I think it was like a handful, it's like 4 or 5 of those 70, 80 observations. There's only 4 or 5. But I think that if I had to put a number out there, that normalized, that 8 to 10 with the tailwinds that we have in place, valuations, inflation's the one thing we got to kind of keep our, make sure we're kind of watching here as well. And you're seeing it. I think the year is going to play out kind of how this first few weeks of January have played out. We've had a couple nice days, a couple mixed days, and there's going to be some corrections, right? There's
Absolutely.
As you as an advisor and us as a portfolio manager and clients as well, we'd love to say, okay, well, you said normalized year, we're going to do 10%. That's going to give me a little less than 1%. If we are a straight line every month, that would be fantastic.
Yeah.
It doesn't work that way.
Doesn't work that way. No.
We expect some corrections, maybe, that 5 to 10% pullback. And, who knows what it is? Maybe some, policy comes in or some foreign price of oil. The other thing we haven't touched, that's actually gone up. Yeah, that's kind of gone up quite a bit here recently. Again, that could be, what's going on with the Middle East and other things as well. The Russian sanctions and things like that. So it's gone from $68 to that $78 as of this morning. So that's when price of oil goes up. That's another tax on, again, back to tax. That's a tax on consumer, right? Especially if you're driving a lot, that takes more money out of your pocket, which could slow the overall economy. I think the normalized price of oil should be in that $60 to $80, $85 range. So we're at at 78 right now. We're at 65 almost. So it's in that range. But I mean, we start getting to that 85, 90, that would be, again, more of a tax on the consumer. That could cause a little less spending, earnings would be a little less, then your stock market would struggle a little bit as well. So those are some of the things we're looking at. There's a lot of, different things. And you do a great job. We talk about bringing an umbrella. We talk about some ways. What do you mean by, Keith? What do you mean by bringing an umbrella? Well, you certainly can do that by rebalancing your portfolio, right? If you have those 2 back-to-back years, which, again, most of your clients aren't straight stocks anyway. Right? There's a 60-40, right? They have 60% in the stock exposure, 40 kind of that safe green money. Now, if the 2-year back-to-back on that 60%, though, that actually is almost 60% as well. It's 59.5%. So that 60% allocation now grew up to almost 70%. And so what we, as investors, they could take that extra 10% and put that back on the safe side. That's one way of bringing that umbrella, right? Take some of that profits and put it back more into the safe side of things. And on top of that, now with where the 10-year bond is, as of this morning, it was almost at 4.8%. I think that's getting at the high end of the range. So there actually is some ability to earn over 4% in the bond market, which is very nice, right? Safe side of things. And
we haven't seen that in a couple of years. So
we haven't seen that. And so that's why
in a while.
I think we're kind of in a sweet spot for your clientele, right? Someone that's in retirement, decent Goldilocks where the stock market still looks good. We're, that 8 to 10%, bonds hanging around 4%. You can do that. When you
If
match
you can
it all
average out a
together,
6 to an 8% overall
That's-
average return in the portfolio. I mean,
yeah,
that's
that's
and
the
again,
math.
you touched on a lot of it has to do with diversification. First of all, it's allocation. How much do we have
Yep.
allocated to equities or stocks or fixed income investments? And then what's our diversification when we're inside of there? Two things that we keep an eye on very closely with all of our clients is the allocation and diversification, and continually monitoring and rebalancing, because
Yep.
it's real easy to just get the old term fat and happy, right? Like I made 20%, I made 20%, I made 20%. And what happens if we just keep going back to the trough? I use the little piggy now, the little piggy that just can't get away. He's the first one to go to the slaughterhouse. So I instill that in all my clients, and all the plans I build is proper allocation based on your risk tolerance, your goals, your objectives, and then continually review, monitor, and reallocate, rebalance. And like you just mentioned, Keith, because we can make great money but if we don't protect ourselves and bring the umbrella, pull some of your winnings off the table, protect those, because, and you're a numbers man, so you might know the exact statistic here, but I think it's somewhere around 2 to 3 times a year the S&P 500 corrects itself anywhere between 5 and 10%. And correct me if I'm wrong on those numbers, or help me out there.
That's the number.
I mean, think about that. So we think what did we just have 2 years ago? 25% plus up. Last year, 25. That's crazy.
Yep.
Well, bring an umbrella, because that's not healthy and normal to continue like that. And even in those years, we saw some corrections.
Yep.
Maybe it was an hour,
Shallow
maybe it was a day, maybe
Yep.
it was a week, but those are actually normal. We might see a week to 10 days where 2 to 3 times a year the market's down 5 to 10%. That's not a panic time. That's actually kind of a breathing opportunity for the market. It's a rebalancing opportunity as well. And so I think that's very important to point out, as you mentioned, we can't just keep going straight up. Bring an umbrella, prepare for some volatility, do some reallocation, rediversify, pull some of those chips off the table. You also touched on, so I want to kind of finish out whether it's this segment, if we got to take a break, or we'll get into the next segment.
We should probably take a break.
Okay, let's take a break real quick then, Tony. Go ahead and give away a few more copies of the book, please. And then we'll jump right into the next segment. And just to prepare our viewers and our listeners, Keith mentioned something like bonds and interest rates and the Feds and inflation. I want to touch on that a little bit moving into 25.
Yikes. Wow. We're going to finish strong. Well, the books, Jason, you're feeling generous. We're giving away even more copies. You're going to have to order some more. I think we're going to run out, but
we just placed another order, Tony. So we're all set there.
All right. 10 more copies of the book. It's Empower Your Retirement. And do not retire without a copy of this book. A lot of great information in there. All you have to do is pick up the phone and give Jason and everyone there at Great Lakes a call. Jason, how can they get a hold of you and the team there to get that book at no cost shipped to them?
Yeah, the quickest way is just pick up the telephone, 989-835-7203. Again, that number is 989-835-7203. Or you can check us out on the website. A lot of great information there. You can request a copy of the book. You can request a no cost, no obligation visit with myself or another member of my team. And the website is GreatLakesInvestmentAdvisors.com.
All right. Sounds good. And you are listening to your Financial Empower Hour. I'm your co-host, Tony Shore, and I'm here with Jason Cryderman, our host with the most, as always. And we have a very special guest in studio today, the man, the myth, the legend, the portfolio manager at Gradient Investments.
Yeah. As soon as I leave here, I'm going to go get that stamped on, my office.
You need a jersey that says King.
Yeah, you need a jersey, maybe get a little tattoo or something. I mean, if you're going to live, man, live at large, right, man? Live at large. So
yeah. Well, the success you've had there at Gradient Investments is great, Keith. You do a good job for Jason and his clients and the people that utilize Gradient Investments. But Jason, you had some things you wanted to ask Keith about here in our final segment.
Yeah. Excuse me. Yeah, we talked quite a bit on the show so far about the markets and PE ratios and growth and S&P Magnificent 7. But let's touch on a couple sectors or areas of maybe opportunity yet concern moving forward. Keith, as you mentioned in the last segment, you said inflation and interest rates with Feds and how that has had historically an impact on bond rates in the markets. And let's talk more about what's going on today. What do we anticipate moving forward, and what might what might 2025 look like when it comes to inflation, interest rates, bond yields, those types of areas, which is really a lot different than equities in the stock market.
Yeah, exactly. You touched on there. Those are all related. So we'll kind of set the stage for how we're looking at interest rates going forward. Now, what a primary driver of the short-term interest rates is absolutely the Federal Reserve, right? So when they're raising rates going back to 2022, we had high inflation. They started raising rates to cool the economy, bring inflation down. They've done a good job on that. We got to the end of last year, and we finally to a point where they thought inflation was relatively under control. They actually reversed course from that tightening to the actually cutting phase, which should become more dovish, which generally speaking, as an investor and a stock guy, investors like lower interest rates, easier money policies, right? Because it's puts more money back in the economy. Consumers can borrow at a lower rate. Again, get that cycle going.
Companies can borrow at a lower rate.
Exactly, right? So as rates come down,
money's cheaper, right? Money's
cheaper, right?
Yeah.
And so they went from 5.25 rates all the way down. They made 3 cuts, one of 50 and 2 of 25s. Now they're at about 4.25. Now the expectations going, say again, that's what happened yesterday. Tell me what's going to happen going forward, right?
Sure.
That's what's going to drive interest rates and kind of that overall impact the overall stock market and certainly on the bond side of things. Now, as we're getting, I think inflation's becoming a little harder to reduce to that 2% than they originally thought. Expectations, the street's expectations, not mine, were that they would have 6 to 7 Fed cuts next year. So that when we're talking 6 to 7, that means 150 basis points to 1.75 basis points. So that's what we are expecting. And now as things are becoming, economy is really strong, inflation's a little stickier. We got a new administration with potentially growth policies. The Fed's actually come out at the end of December in their last meeting and said, we're going to be more in that pause mode. So that kind of investors on the stock side, like, what's going to happen here? And then on top
mindset,
of it,
sure.
Exactly, right? That's 6 to 7 now down to 2 cuts for next year. And there's no cuts in the first 3-4 months of the year kind of forecast. And I think that's where they should be. And that's kind of where our team was last year. We thought going into last year, expectations were at 8. We thought that was too high. We thought it was going to be like more to 4 to 5. And what they do, they end up doing 4. We think that 6 to 7 is too high. We think 2 is right. Now, the funny thing is the job report that just came out on last Friday came in at 4.1%. Throwing a lot of numbers here. Again, I told you that's a very strong jobs number. The market actually sold off. And that's one question I get is like, well, Keith, you tell me people are employed, they have money in their pockets. That's good for the stock market. Why did the market sell off?
Sure.
And the reason that the stock market sold off was because that meant more indication that the Fed would stay on hold because we have a strong economy. So you kind of get, it's a little perverse. And I think that was a little bit of a silly reaction because I'd rather have rates where they're at right now, stay flat without the cutting, but have people employed at 4.1%. They'll have money, and when people have money, they spend. Well, Jason, would you feel a little better about rates being lower and not having a job, or rates kind of where they're at and having a job, right?
I think it's a no-brainer, right? I mean,
it's a no-brainer.
I mean,
Exactly.
It's interest rates are one of those things that it's bittersweet. It's a two-edged evil and a positive sword, right? I mean, when we borrow money, we want low interest rates. But yet when we invest money, we want high interest rates. And so interest rates is a really, really interesting creature. And I really think when we look at inflation and interest rates, they do work really interestingly with each other and against each other. And I think right now, kind of where we're sitting, I would kind of chime in with what you're saying. There is more cuts for lower rates. I don't think that's as healthy for the economy, because if all of a sudden employment goes up and taxes go up, now there's 2 negatives and that's I think just does not paint a very pretty picture for the market, the economy, or individual consumers either way.
Exactly. And you summed it up well. And then the reason that I like to keep the Fed where they're at right now at that 4.25 is if the economy does really slow and, other negative things happen in the overall economy, the Fed can step in and start cutting rates aggressively.
Yeah.
And that would stimulate the economy. The economy is doing great right now. GDP, we haven't talked about. GDP is going to finish, this year at 2024. We haven't seen the final numbers. It's almost 3%. I think it's like 2.8, 2.9. Now, again, what do we care about? We care about going forward. Expectations for this year at 2.7%. Wow. That's fantastic. I mean, so anything above, that 1.5 to 3% range, that's a good range for GDP. If the economy is going, you got unemployment going well, that 1.5 to 3, if we do a 2.7, that's closer to the high end of the range. that's a positive backdrop for all the stuff we're talking about. And so, especially your clientele, they are in retirement or close to retirement. So I think they're kind of in this Goldilocks situation where we painted a pretty good picture of rosy picture of what the stock market could do. Oh, and by the way, the Fed's not lowering rates, so the bond yields themselves should hang kind of where they are right now, right? The long term, the one that kind of gets quoted most often is the 10-year average on the Treasury yield. That's actually backed up. It got as low as 3.75% when they thought the Fed was going to start cutting and the economy was going to slow a little bit. We're sitting right now, as this morning, almost at 4.8%. That's a big move to the upside. So we got to remember. So when bond yields go up, that means bond prices are going down. So if the next question you may ask is like, Keith, what was the bond market done year to date? Then the bond market's actually down about 1%. That's because those yields have continued to go up. But if nothing would change, you hold your yields and you're yielding over 4%. So that kind of gives you back to that rosy scenario. If you are putting more money, especially if you rebalance, took it off that overage, returns that you had in the stock market and start buying those bonds right now. I think you have that nice yield. I think it's a very good spot for people in retirement right now.
Yeah. Well, guys, great show, but we have to end here. We're out of time. Jason, give that number again so our listeners can get a copy of the book or set up that no charge, no obligation consultation.
Yeah, it's easy to do. Just call the office here, 989-835-7203.
All right. And that does it for today's episode of your Financial Empower Hour.
Hey, thanks, guys. Have a great day.